If you own property in Utah or you're thinking about buying, you're standing directly in the path of a market shift that is no longer subtle. The era of blind bidding wars, waived inspections, and sellers naming their price like they were untouchable is fading fast. Across city after city, inventory is building, showings are thinning out, and price cuts are starting to do the work that hype used to do. What we're looking at now is not a little seasonal cooldown or a harmless pause after a hot run. This is a deeper reset, one that has the potential to erase years of paper equity a lot faster than most owners still seem to believe. And if you think this is only happening in fringe towns or weaker pockets of the state, keep your eye on the city at the very top of this list, because the place that once looked like Utah's crown jewel is now leading the decline. By the end of this, the pattern becomes hard to ignore. The places that ran up the fastest, the places that were sold on momentum, ease, and endless demand, are now the same places getting hit the hardest as affordability finally pushes back. Start in Logan, up in Cache Valley, where the quiet, small-town distance that once felt like part of the appeal is starting to read differently. What used to feel like charm now feels a little more like isolation, especially when buyers are being forced to think carefully about jobs, wages, commute trade-offs, and long-term value. Logan has always been, at its core, a college economy. That matters more now than it did during the boom. Student-driven demand can support rentals, can support certain price bands, can support investor optimism for a while, but it does not support permanently inflated home prices in a market where local incomes remain grounded in reality. And that's the lesson Logan is beginning to learn. It has that same uneasy feel markets get right before the narrative fully breaks. Not dramatic all at once, just enough small signals piling up that you can tell the temperature changed before everyone is willing to admit it. Homes that would have vanished in a weekend are now sitting for weeks, then months. Signs stay planted in yards long enough to start looking normal again. Inventory has climbed sharply year over year, creating more choice than local demand can absorb, and prices have already started to pull back from their highs in a meaningful way. This is not just the usual winter slowdown or a temporary lull. Buyers here are resisting. They are refusing to stretch into numbers that no longer make sense against wages, rates, and daily life. That's what matters. The market is being repriced by affordability, not by optimism. Add in a rising absorption rate, slower turnover, a decline in new single-family permit activity, and a price-to-income ratio that has drifted far beyond what a rural economy can comfortably carry, and Logan starts to look less like a safe haven and more like an early warning. Sellers are cutting, listings are lingering, and a place that once looked stable is now showing the first real signs of strain. Move south into South Jordan and the mood changes, but the pressure doesn't. This was one of the symbols of Utah's polished suburban boom, the kind of place people pointed to as proof that master-planned living, new construction, and family-oriented growth would keep attracting buyers no matter what rates did. For years, areas around Daybreak and the surrounding neighborhoods represented the finished version of the dream: clean streets, new homes, well-marketed communities, and endless demand. But one of the risks in that kind of market only shows up after the rush is over. When so many houses are similar, when the streets are full of near-identical layouts and interchangeable finishes, and when several sellers are trying to exit at the same time, the main lever left to pull is price. That's where South Jordan is now. What used to be an advantage, consistency and polished supply, is becoming a liability because buyers suddenly have too many comparable options. And once buyers can compare freely, price pressure becomes unavoidable. A striking share of listings here have already cut asking prices, which tells you sellers are feeling the shift even if they still hope to preserve their equity on the way out. Homes are taking more than twice as long to sell as they did a year ago. Rental investors are discovering that easy hold assumptions don't hold up when vacancy rises and financing stays high, and the first signs of delinquency stress are beginning to appear around the edges. None of that means collapse overnight, but it does mean the old assumption of easy liquidity is gone. Add in high home values, expensive ownership costs, substantial HOA burdens, and builders still trying to unload finished units with aggressive incentives, and South Jordan starts to look like a market where supply is no longer a strength. It's a weight. One out of every few sellers is already marking down. More will probably follow. Then there's Lehi, which may be one of the clearest examples in Utah of how quickly confidence can evaporate once the industry supporting the housing story starts wobbling. For years, Lehi was treated like it had cracked the code. Tech wages, startup energy, big office campuses, venture money, rapid expansion, constant relocation traffic. Silicon Slopes wasn't just a slogan, it was an economic story people used to justify almost any home price. Buyers convinced themselves that proximity to the corridor made anything sustainable. But housing markets built around one dominant growth narrative become vulnerable the moment that narrative weakens. And that's what's happening here. The tech sector has cooled, layoffs have hit, office footprints look less essential than they did before, and suddenly the logic of paying top dollar for tightly packed suburban homes near freeway exits doesn't feel as bulletproof. That shift shows up fast in the numbers. Prices have come down meaningfully from year-ago levels. Active listings have surged as more owners test the market at once, and sellers are increasingly taking less than they wanted just to get deals across the line. A noticeable share of contracts are also falling apart before closing, which tells you the fragility isn't just on the listing side, it's on the buyer side too. Financing problems, second thoughts, recalculation, all of it. Even before you factor in concessions, buy-downs, and quiet giveaways, the pricing power is gone. New construction inventory is piled up, builders are sitting on completed homes, and the underlying problem is simple. Lehigh expanded on the assumption that growth would remain uninterrupted. Now that hiring and investment have slowed, the city is having to find out what demand actually looks like without the hype premium. And demand, it turns out, isn't strong enough to absorb what was built at the prices people expected. Keep moving west and you hit Harriman, which in a lot of ways captures the downside of rapid suburban expansion better than almost anywhere else in the valley. This is what happens when development outruns the infrastructure that was supposed to support it. Neighborhoods multiply, rooftops spread, and for a while the momentum itself becomes the marketing pitch. But eventually roads matter, school capacity matters, taxes matter, commute quality matters, and household budgets matter. Harriman is full of townhomes and small-lot single-family properties, many purchased at the height of the market by buyers who stretched hard to get in. 2 years ago, that stretch looked rational because everyone assumed appreciation would cover the pain. Now inflation is chewing through monthly budgets, property tax burdens are rising, and the exit door is getting crowded. Distress here is not just theoretical. Default activity has moved up, inventory has surged sharply, and many owners are discovering they are no longer just competing with their neighbors. They are competing with builders offering brand new homes at prices below what existing owners paid near the top. That is an especially ugly setup because it traps people in place. They can list, but they can't sell without taking a hit. They can rent, but they may become reluctant landlords in a softer rental environment. They can hold, but holding comes with carrying costs that don't stop climbing. The headline decline in median price only tells part of the story because a lot of the real pain is hidden in concessions, closing cost coverage, repair credits, and the time value of homes sitting unsold while sellers carry dual payments. Homes linger longer now, rental vacancies are climbing, and the market is starting to show the marks of overbuilding colliding with affordability fatigue. Harriman doesn't just feel slower. It feels overextended. If you push even farther out, past where the valley starts to thin and the sense of distance becomes part of daily life, you get to Eagle Mountain, and this is where the phrase "drive until you qualify" becomes more than a cliché.